Afternoon, everyone. My name is Diaz, and I am from Ebury Canada, the Toronto office. It is a pleasure here to welcome everybody on this webinar, where we will get the opportunity to scratch basically the surface of next week's key event, the US presidential election. We have our panelists here. They will share the insights on the implication of either a blue or a red White House next week and its impact on the currency market. Before we start, I would like to briefly introduce our panelists. So joining us from New York is Ebury's Chief Risk Officer, Mr. Enrique Diaz-Alvarez. He has been with Ebury for around 9 years, and he oversees the global Ebury's strategy department. Enrique is also a Bloomberg FX forecaster with a history of being ranked among the top forecasters for many of the currency pairs. And we have across the Atlantic Ocean, we have Matthew Ryan. He is our senior market analyst based in London office. Matthew has been with Ebury for over 6 years, and he produces on a regular basis the FX analysis content for Ebury's client, and he covers a wide range of major and emerging market currencies. So without further delay, I'd like to give the virtual floor to Matthew and Enrique to share their insights. Thank you, guys.
Thank you very much, Viyash. And hi, everyone. Welcome to our webinar ahead of next week's US presidential election, its potential impact on the foreign exchange market. I think we'll get going. I'll start with a brief summary as to what we're going to cover in today's webinar. So we're going to start by giving the latest state of play, the latest opinion polls, the latest implied probabilities, who is ahead leading up to next week's vote. I'll then briefly talk about how the US voting system works, the Electoral College voting system. I'll then hand over to Enrique, who's going to talk a bit about some of the key swing states, which states to look out for on election night and who's ahead in those states. We'll then talk a bit about the financial market reaction leading up to the vote. And then, of course, how we think that the FX market will react following the vote, whether that be the US dollar, risk assets, or more specifically, the Canadian dollar. So that should take around about half an hour, maybe 40 minutes or so. We'll then have time at the end for questions. There is a Q&A section in the Zoom app. So if you have any questions as we go along, please feel free to type your questions in that Q&A app, and we'll get around to answering those at the end. So we'll start to begin with the latest opinion polls ahead of next week's election on Tuesday, the 3rd of November, which we think is going to be the biggest event risk in FX between now and the end of the year. Now, Democrat Joe Biden continues to hold a pretty strong, healthy advantage leading up to the vote of around about 8% or 8 points, 51% to 43%. His lead has narrowed slightly in those poll of polls in the last week or so from around about 10%. Although if we could compare that to before the pandemic, it was around about 4 points. So we've seen a bit of a widening in those polls in the last few months. Now, campaigning really picked up pace end of September time for the first televised debate between the two candidates. There was a general air of expectation going into this debate that Donald Trump would use that opportunity to close the gap in the polls, as has often been the case following first televised debates in past elections. Actually, his rather poor showing in the debate widened the polls further. And then we had, of course, Donald Trump's positive COVID test, subsequent hospitalization and quarantine period in early October, which has dented his chances of re-elections further. He's missed campaigning in some of those key swing states, particularly like Florida, Arizona, for instance. And we saw the polls widening further. So the lead in those poll of polls is around about 10% around about a week or so ago, having been about 6% prior to that first TV debate, although as things stand, around about 8 points between the two candidates, which is still a fairly comfortable, commanding position for Biden as things stand. Now, one of the big questions going into this election is whether or not the polls will be proved accurate this time around, having got the 2016 election completely wrong. Investors are actually fairly confident that history won't repeat itself and that the polls will be slightly more accurate this time around. Of course, we were to cast our minds back 4 years in the past election. Hillary Clinton was well ahead over Donald Trump leading up to the election, only to lose the vote, lose the race to the White House on election night. We're fairly confident this time around that won't be the case. There are two reasons as to why that is. The first of them, you can see from looking at the graph on the right-hand side. So this represents Joe Biden's lead over Donald Trump this year, which is a darker blue line, versus Hillary Clinton's lead over Donald Trump, which is a lighter blue line. So you can see Biden's lead has been considerably larger than Clinton's was over the same time period since around about early to mid-May time. And actually, if you look at the difference between the lead for Biden today versus Clinton's lead at the same time period, a couple of weeks or week leading up to the vote, Biden's lead is larger, and actually Clinton's lead fell to less than 2% in the days leading up to the vote due to the email scandal that marred the end of her campaign. The second reason why we think this time will be slightly different to 4 years ago is that the pollsters, we think, have learned their lessons from last time. The surveys in 2016 are actually largely correct at the national level. Hillary Clinton did win the popular vote. She had obtained more votes than Donald Trump, only to lose the election due to the Electoral College voting system, which we'll talk about in a couple of slides' time. The real issue was instead with the state level polls, predominantly the fact that they tended to overweight college graduates, most of which voted Democrat. So this time around, those state level polls have been weighted by education. So this, we believe, should lead to a sample that's more representative of the overall voting population, and hopefully should lower the chances of these polls being wrong this time around. So we think actually, if Biden was to lose the election, if Trump was to win this time around, it would probably be a greater surprise than we had 4 years ago, where the lead actually for Clinton was much narrower than it is for Biden this year. So what are the implied probabilities saying leading up to the vote? Well, there are three main indicators of implied probability that we look at, have been looking at in the few weeks leading up to the election. The most noteworthy is probably that from 538, which simulates the votes 40,000 times. It then congregates these outcomes, aggregates them, comes up with an average probability for each candidate. And that's currently showing around about an 87% chance of victory for Biden, which has grown slightly in the last sort of month or so over Trump. Similar measures from Predictive, which is online election prediction websites, and implied bookmaker odds. So a slightly less higher chance, slightly lower chance, I should say, of a Biden win, but around about 63, 67% still give Joe Biden the clear edge. And this, we think, is generally a pretty good barometer as to what the market is pricing in. Actually, if you look at the implied probabilities here, that increase in the implied probability of a Biden win has coincided with a rally that we've seen in risk assets as the market becomes increasingly more confident of a Biden win. So all this really does suggest that we probably have to see a pretty significant turnaround in the last few days of the campaign in order for Biden not to win and for Trump to win next week, which we don't think is likely to happen. We don't think there's enough time for such a sharp turnaround. So how does the US voting system work, the so-called Electoral College voting system? Well, the President of the United States is not voted for by popular ballot. Instead, each state is assigned a different number of electors, of which cast an electoral vote. Whoever wins in each state gets all the votes. So regardless of whether each state wins 99% of the vote or 51% of the vote, they'll receive all the votes within that state. These votes are assigned based on population within those states. So the most populous state, California, therefore has the most seats, 55. Then we have Texas, I think 38, Florida, 29, I believe, so on and so forth, all the way down to the smaller states that have no less than 3. So a state such as Alaska, for instance, which is the largest state in terms of landmass, but has the one of the smallest populations that has the least amount of votes, only 3, due to the fact that it has a smaller population. So the winner would need to obtain at least half of these votes, so 270 is the magic number to look out for. There's never been a tie, but if there were to be, which is very unlikely, that would be settled by the House. Now, a complication to the elections is that Americans will also be voting on the composition of the US government, which is both the House and the Senate. So all 435 seats in the House will be contested, as will 35 out of 100 in the Senate. Now, the reason why this has a significant bearing on the election is that the president has full control of Congress, full control of the US government, makes it much easier for them to force through policy changes than if they would control either one of just the House and Senate. If we look at President Trump's first 2 years, it was much or relatively easier for him to force through policy changes than it was in the last 2 years of his administration, given that in the first 2 years, the Republicans had control of both the House and the Senate. But following the midterm elections in the last couple of years, where the Republicans lost the House, it was much more difficult for these policy changes to be forced through government. As things stand, the Democrats look very likely to retain the House. Actually, I think there's a pretty good chance they get the Senate as well. And Enrique will talk a little bit more about the impact they'll have for FX in a few slides' time. And I'll now hand over to Enrique, who's going to talk a bit more about the swing states.
Okay, the so-called swing states is really because of the electoral system that Matthew just described is where the election is decided in the US. It's a handful of states where the outcome of who's going to get the most votes between the 2 main candidates is not known ex ante. And that is where the bulk of the campaigning is done and where the bulk of ads are purchased. And for instance, I'm in New York, I barely see any campaigning because it is assumed that the Democratic candidate, whoever it is, will carry the state and all the electoral votes, and therefore there's no point for either campaign to spend any money or any time in New York. These are the main states that decided the election in 2016 were Florida, Pennsylvania, Ohio, Michigan, North Carolina, Arizona, and Wisconsin. These were every single one of them carried by President Trump in 2016. And as we can see, every single one of them, except for Ohio, are being led right now by Biden. This is basically the basis for our position that the polls are, that the betting markets are correct, and that Biden has somewhere between an 80 and an 85% chance of winning the election. Not shown here are a couple of a few states that make it even more difficult for Trump to win this election. In that Georgia, Iowa, and Texas, which used to be locks for the Republican candidate in the same way that New York, for instance, is a lock for the Democratic candidate, are now competitive. Georgia and Iowa are too close to call. The polls are essentially have a statistical dead heat. And Texas, Trump is still ahead, but barely. Most polls have him between 2 and 4 points ahead. This makes it even very difficult for the Trump campaign, because it means that instead of focusing on these 7 states here, it also has to spend time and effort and money and focus on states that in 2006 it could more or less assume that they were a lock for Trump. If we can move to the next one. Again, this is just a graphic illustration of what I said, the big changes from the 2016 presidential election voting map. The Midwestern states are states that have similar economies, that have had undergone a process of deindustrialization since the 1980s and the 1990s. Used to be the main source of electoral strength for Trump, and most of those are either too close to call or rather in the Democratic, leaning Democratic. This is a map that makes it very difficult, we think, for Trump to turn things around. the argument, and it's a fair argument, that in 2016 Trump outperformed the polls. And again, the counter argument is that he would have to outperform the polls by a considerably larger margin than he did in 2016, because the lead both at the national level and at the key states is so much higher. And second, that the pollsters and analysts have, if anything, put their thumb on the scales in order to avoid making the same mistake than 2016. And therefore, we think a lot of analysts out there are purposely playing down the chances of Biden in order to avoid an embarrassing polling mistake like what happened in 2016. Move to the next one. In addition, we don't want to put too much emphasis on the immediate impact of the COVID-19 pandemic at the state level. Clearly, at the national level, the worsening of the pandemic happens at the same time as Biden locks in a significant lead in the polls of over 6-7% back in the spring, and the pandemic never really gets better, and the numbers don't get better, and President Trump never closes the gap. But right now, if we look at the swing states that I mentioned as the key in the election, and the numbers for the pandemic, we have clear deterioration in a lot of them. Ohio is not affected here, but Ohio is one of the states that is experiencing almost daily records in the pandemic. And this is just a string of negative headlines for the incumbent that make it even more difficult for Trump to close the gap. To the extent that the electorate is thinking of COVID, that is advantageous to Biden, because the electorate gives much higher marks to the Democratic Party in general, to Biden in particular, in terms of their ability to handle the pandemic. So the more the COVID numbers and the COVID pandemic systems for the headlines, the more difficult it is for Trump to overcome the deficit in the polls. So I'll move to the next one. So now we move from our prediction of the election, our view of the election, to our view on the financial impact and the market impact of the election. The first thing probably we should do is take a trip down memory lane and remember what happened when Trump won in 2016. The US dollar, clearly the markets were caught wrong-footed. They did not expect this outcome. The dollar sold off on election night, as did stocks. And then very quickly, within hours, markets reversed completely. Asset prices started to go up, stock market, credit, etc. And the dollar rallied, in the case of the euro, to near parity with the euro. Of these two trends, one of them continued during the presidency. Equity markets and in general, all asset prices rose sharply. And the euro dollar, however, the euro managed to recover most of the initial losses that against the dollar that took place in the months immediately after the election. However, we should really keep in mind that market moves have reacted more to the international context and very favorable monetary policy, both from the European Central Bank and the Federal Reserve, than Trump's policies, whether positive or negative. But the one thing is clear is that markets hate uncertainty, and they much prefer it, especially in the short term, when events follow expectations. So this is a view of how the markets have reacted, the currency markets have reacted in 2020 as we got close to the election. We can think that we opened the window of reaction to the election in August 2020, where the fears of a complete pandemic meltdown appears to ease somewhat, and markets will start focusing on the election. The euro dollar, the dollar has gone clearly as the markets increasingly priced in a Biden victory. They have priced in increased hopes of U.S. stimulus and increased hopes of a positive resolution to the trade uncertainty and the trade conflicts that the Trump administration has fanned since they were elected in 2016. Equities are up sharply since late September. I think that that's a movement that can be attributed almost entirely to this comfort of the financial markets over the likelihood of a Biden victory. In the next few days, the next week to the election, we were expecting, we think that when the stock markets reached all-time highs in the previous weeks, they had priced in all the positive news from a Biden victory. Now, we've seen a significant pullback today in risk assets. That's mostly has to do with the COVID pandemic. Some of it may be attributed to uncertainty over to a new bout of doubts of the election next week. But the other aspect of the Biden lead has had a positive impact on markets is that the prospects of a contested election in which either no winner is called by the US media or the state authorities, or a winner is called but Trump refuses to accept defeat, looks less likely now that Biden's lead is more solid than it did a few months back. The lower likelihood of such an event, which in our view is quite unlikely, and we'll talk a little bit about why, is a big driver of the move higher in risk assets over the last few weeks. So the hardest element, or the worst uncertainty over this election is whether we go into the election on Tuesday and by Wednesday morning we still have a winner, or we have a claim winner and one of the candidates, in this case it would have to be Trump almost certainly, refuses to accept defeat. Some of the data that has led media organizations to worry about this is that the mail-in ballots, the percentage of the ballots that are mail-in ballots are going to double from 2016. There's also a lot of early voting, and this somewhat increases the chances that we won't have an election result right on polling day. Now, it's become increasingly clear that we might have underestimated the capability of state authorities to count the votes. The vast majority of the mail-in ballots will be in and ready to be counted on election day. A lot of early voting in the states that allow it is taking place. Those ballots will also be in the boxes, so to speak, and ready to be counted. So unless the polls are really as significantly off the reality, we think that it's going to be very difficult not to have a winner called on election day. Now, however, it's not a possibility that we can rule out, and we think that the initial movement would be a semi-panic in the markets, would have investors flocking to safe haven assets. That would be initially a dollar positive, because the dollar together with the yen and the Swiss franc is considered a safe haven. However, I think that on the long term, if we were to go days and weeks without a winner being called, or a winner being called and Trump refusing to accept defeat, this would be a negative development for the dollar, because it would bring about quality concerns over the American institutions, which tends to be a negative for any country's currency. And going beyond this downside scenario, which we still regard as quite unlikely, these are probably the two most likely scenarios in addition to a Biden victory, The other election that will have a significant impact on market reaction would be that for the Senate. We think that the House, the Democratic lead in the House, is solid enough that it would be very difficult for the Republicans to recover it. I think there's a less than 2% chance of that. There's not quite, in our view, not quite a 50% chance that in addition to a Biden victory, the Democrats take back the Senate, what is called a blue wave. We think that the immediate reaction would be a positive one in stock markets, in credit markets, and a negative one for the dollar, as a significant fiscal expansion is priced in by markets. It's clear that whatever stimulus package, a general stimulus package from the Congress, would be signed by Biden into law as quickly as January. The only this positive impact on markets will be only partially offset by the prospect of a repeal of the Trump tax cut of 2017, which would primarily impact corporate taxation, driving it higher. But overall, clearly, the initial reaction would be for a lower dollar and a significantly higher stock market. This 1/3 roughly chance that Biden wins the election, but the Republicans just barely managed to hang on to the Senate. There would be no repeal of the Trump tax cut of 2017, and whatever fiscal loosening would be very, very modest. However, given that the trade policy is the purview of the presidency, we would not have to worry as much about the trade conflict and the accompanying headlines of a trade conflict between the US and China and between the US and the European Union. So the impact on markets would be a muted version of the democratic wave with a modestly lower dollar and a very moderate rally, perhaps, or even flat risk assets. We think that the scenarios in which Trump wins, with or without the House, are very similar. The Trump tax cut of 2017 is protected. Whatever fiscal expansion happens would be extremely modest, if at all. And we would continue and perhaps renew with more strongly the trade tensions with China and with the Eurozone as a emboldened Trump takes on the Republicans' establishment in this area. So I think I will pass on the baton now to Matthew to take it from here, to talk specifically about the impact on the Canadian dollar and the Canadian markets.
Perfect. Thanks, Enrique. Yeah, so we're going to shift our focus next few slides, Enrique said, to the Canadian dollar and Canadian economy. So talk a little bit about how CAD has reacted leading up to the vote, what we expect following the vote, and then give a little bit of a preview ahead of Wednesday's Bank of Canada meeting, which is shaping up to be a bit of an event risk for the markets this week. So the Canadian dollar has continued to recover pretty strongly in the past few weeks leading up to the vote, having, of course, fallen to its lowest level in over 4 years during the peak of the crisis in March. Actually, it's now roughly trading roughly where it was before the pandemic, and has recovered around about 10% since the trough in the height of the pandemic in March. Actually, if we look at the last 3 months or so, the Canadian dollar has been the best performer out of all the G10 currencies. There's a couple of the main reasons why we think that's the case. First of them is the performance of the Canadian economy, which actually has been very resilient and outperformed a lot of its major peers within the G10, in part due to the government's handling of the pandemic. If we look at indicators of economic activity, consumer spending has been very strong. Retail sales, for instance, has been back in positive territory year on year for the last 3 months, and now is in excess of 3%. We look at exports, for instance, have shown signs of a bit of a V-shaped rebound in the last few months. And actually, many sectors within the Canadian economy, output within those sectors is now greater than it was before the pandemic in February. So there's some pretty encouraging signs of recovery there. And as you can see there, we think this is in no small part due to the strong performance of the Canadian labour market, which has rebounded and added jobs at a quicker pace than many of its peers. Compare with the US, for instance, so the Canadian economy has added 75% of those jobs that were lost during the crisis period have now been recovered, versus less than 50% in the US during the same time period up to the end of September. All of which, as we think, has fueled part of this strong rebound in the Canadian economy. The second factor would be the large fiscal support that we're seeing from the Canadian government, which actually in relative terms of GDP, is one of the largest in the world among the major economies. Around about 16% of GDP for this fiscal package, and compare that to the US, around about 13%, and many countries in Europe quite a lot less than that. I think Germany's around 9%, France and Italy 5 or 6%. So this is, I think, this huge fiscal support that we're seeing, partly the reason why we're seeing both this strong rebound in the Canadian economy, and partly why we're seeing this strong rebound that we've witnessed in the Canadian dollar. So what do we expect following the election? Well, we think that Canadian dollar will probably react in a similar fashion to how we've outlined risk assets. Under a Trump win, we probably get status quo trade policy. Of course, during his presidency, Trump has instigated the renegotiation of NAFTA, also slapped tariffs on Canadian imports, and threatened stronger action on Canada as well. While the Trump administration has backtracked on its proposal for a 10% tariff on aluminium imports from Canada, should we get another 4 years of the Trump administration, we think that the reintroduction of that tariff is possible, and potentially even additional tariffs in the future, and greater trade uncertainty in general, which of course would be a negative for the Canadian economy. As we mentioned as well, we think that a large fiscal stimulus package from the US would be much less likely under the Trump administration, the reasons Enrique mentioned, which would be again a negative for the Canadian economy, given the close economic ties between the US and Canada. So under a Trump win, we'd expect a pretty sharp move higher in the US dollar CAD cross, so a sell-off in the Canadian dollar. And as I said, probably a relatively large one, given that, as we've seen, a Biden win is largely priced into the markets at the moment. So a Trump win would be a big surprise. We'd probably get a bit of a knee-jerk reaction in the Canadian dollar. So under Biden win, of course, we'd expect the reverse of this. So we'd expect a lower US dollar CAD, so a bit of a move higher in the Canadian dollar under a Biden win. While Biden's proposed policies do aim to promote the production of domestic goods in the US, we think there will be less protectionism than under a Trump administration. So improved bilateral cooperation, I should say, less trade uncertainty, and obviously less threat of tariffs on Canadian goods, which, as I said, good news for Canadian economy, given the close ties. The US accounts for around about 70% of Canada's overall exports. And again, as Enrique mentioned, the Biden win, we'd probably likely get a larger fiscal stimulus package, which again, positive for the Canadian economy, which is why we'd expect a pretty decent rally in the Canadian dollar under a Biden win, or slightly less so of magnitude of a move than we would get should Trump win. So I'm going to finish off with a quick preview ahead of Wednesday's Bank of Canada meeting, which, as I said, might be one of the major risks in the market in the next few days. We don't expect any major change from the Bank of Canada this week. We'll see no change in interest rates, most likely. We don't think that the bank will alter its quantitative easing program just yet. Instead, the key to the market move is likely to be the updated economic projections and the bank's view on future policy moves. Regarding the latest macroeconomic projections, while we have seen this pretty strong rebound in the Canadian economy that I've mentioned. There is a threat, a risk that we could see a modest downward revision to the latest growth projections, given the second wave that we're seeing in the COVID-19 virus across much of the developed world. And we're beginning to see that in Canada as well, although albeit a bit of a lag with the likes of Europe and the US as well. So we could see a bit of a downward revision to growth there, which could weigh on the Canadian dollar slightly. Having said that, we think a positive is the fact that the Bank of Canada appears opposed, has very little appetite at the moment for negative interest rates, unlike some of its major peers, which are potentially considering cutting interest rates, the likes of Reserve Bank of Australia or the Bank of England, which is toying with the idea of negative rates, for instance. So we don't think that the Bank of Canada will necessarily think about negative rates or cutting interest rates at all for the foreseeable future. Particularly if we look at the economy, inflation's accelerating. As I said, we got an improved labour market performance in the last few months. This large fiscal package that we've seen from the Canadian government should lessen the need for Bank of Canada cuts. We'd instead see the QE programme as the likely main tool of choice, although again, given this decent performance of the Canadian economy, large fiscal support, we don't think there's any pressing need for a change in that programme anytime soon. So probably a bit of a status quo from Bank of Canada for the short term at least. We may see, as I said, a bit of a downward revision to those growth forecasts. But we don't expect any major surprises necessarily this week. Attention is going to be, as I said, all on the US election next week, and the polls leading up to the election in the next few days, at the very least. So the key takeaways really from the main part of our webinar today. So Biden well clear in the polls, as we've shown, around about 8 points ahead of Donald Trump. We think that the pollsters have learned their lessons from last time around, and the fact that Biden's lead is much larger than Clinton's was 4 years ago. Don't think we'll see such a dramatic turnaround this time around. We don't see we'll see that big surprise on election night, barring this dramatic turnaround in the next few days, which we don't really see happening. So a Biden win we think would be good for risk assets, bad for the dollar. So we think Canadian dollar would rally under that scenario. Under a Trump win, we think the opposite. Although the moves will be to an even greater magnitude given it's not priced in. So it would be good news for the safe haven dollar. We think that would rally. And bad news for both risk assets and the Canadian dollar, which we think would sell off pretty sharply under both a Trump win and a contested vote, which drags out the process long after election night. So that's pretty much it from us in terms of content. Do you guys have any questions at all about anything we've covered? Please feel free to type in the Q&A section if you have any questions. Not seeing any questions come through. Hopefully that means we've covered everything and we've answered all your questions in our presentation. Or we do have one question. The question is, what's our view on high levels of debt in Canada and its impact on consumer spending? Do you have any thoughts on that, Enrique?
So I didn't quite get that. What was the question?
What is our view on the high level of debt in Canada and its impact on consumer spending?
Well, I think that in international terms, the debt is high, but not that high. And frankly, the monetary policy and the pandemic counterintuitively have rendered the high levels of debt in Canada and other countries like Australia less important because the interest rates have collapsed both in the short and the long term, which means that the burden of servicing that debt is much lower. So in a way, this massive shift in rates towards the 0% level everywhere is a boon for countries that have high debt because their ability to, impact of debt service is now much lower than it was even a year ago. So we do not think it will have a huge effect.
Yeah, I agree. So it's only really an issue when we start to see rates increase from current record low levels, and we really don't see that happening at all for a long time yet, particularly in the major developed countries. It could be 2 or 3 years before we get many of these major central banks even consider raising interest rates.
I mean, the Canadian government curve is below inflation, well below inflation, all across the curve, right? All the way to 30 years. This means that probably high debt is probably a positive rather than a negative. But anyway, highly indebted countries, we think, are the winners from the massive shift in rates that's happened over the last 6 months.
So we have another question. Do we expect to see further monetary tools used in the US, i.e. yield curve control, negative rates? And do we see Canada following suit?
I mean, Canada is not going to lead the effort. I think that if all the jurisdictions like the US and the UK follow the European Central Bank and the Bank of Japan in negative rates, the Bank of Canada will consider it, but it will not lead. So we'll have plenty of warning before that happens. And in general, I think that with this second wave being less impactful than the first in terms of deaths and hospitalizations, and the prospects for a vaccine sometime in the first quarter 2021 drawing closer, we think that the Bank of Canada may want to err on the side of caution and just wait and see what happens. So if we had, it's definitely not going to happen anytime soon. And if we had to, over the medium term, we think is less likely than not that we will see either negative rates or direct yield curve management.
Yeah, and we might find out a bit more from the Bank of Canada this week, but as things stand, there's very little appetite for negative rates. I think this large fiscal package by the Canadian government certainly lessens the pressure on them to cut interest rates, and the market's not really pricing in any chance of lower rates anytime soon.
Yeah.
Do we have any forecasts for US dollar CAD end of Q1 or Q2 next year, assuming a Biden win in the White House? And how much is this already priced into the market? We don't have any set forecasts for CAD at the moment under a Biden victory, other than what I've said. I think we, under Biden, we would probably get that move higher in risk assets. Canadian dollar would probably rally, but I think we agree that a Biden win at the moment is largely priced into the market. There's still a little bit of a scope for a move higher in risk assets should Biden win, but given that it's largely priced in, we think that move would be relatively limited relative to the downside we get under a Trump victory. So as we said at the beginning, those measures of implied probability tend to give a decent idea as to what the market is pricing in. So anywhere between sort of 65, 70%, I think it would be priced in for a Biden win at the moment. So we have another question. So inflation is subdued at this time. Do you anticipate inflation being an issue down the road, given the amount of government spending?
It's a difficult forecast to make, but yes, we think that the one thing that can threaten this sort of low equilibrium with extremely low rates and extremely high government spending and deficits, it's a return of inflation as the pandemic impact on the supply side is filters through. We're seeing mixed signs of that around the world. In the US, inflation has bounced back very quickly to the levels what it was before the pandemic. In the Eurozone, we're nowhere near that. Inflation has dropped to all-time lows. So in the medium to long term, it's difficult to see how this policy of deficit spending to make up for labor incomes can fail to have an impact on inflation. But in the short term, the impact to demand seems to be more important. At some point, I think we'll make a transition from one regime of low inflation to one where supply bottlenecks become more important, but we're definitely not at that point yet.
Yeah, we have another question on anticipated rate for US dollar CAD if Biden wins. Again, as I mentioned a couple of questions ago, yeah, it's quite difficult to put specific forecast levels on these political events, particularly given that it's quite a fluid event. When the market is volatile leading up to the vote, it's often a bit futile to put down specific rates that we anticipate following from the vote. But yeah, as I said, we do expect a modest rally in CAD under a Biden victory. Okay, unless we have any further questions from you guys, you might wrap things up there.
Okay.
Yeah, I don't think we have more questions there. Well, thank you very much, Matthew. Thank you, Enrique, for sharing.
Thank you.